we have to accept that there are global risks. There always are risks. But the benefit of trade to the average American in terms of the cost of what he or she buys is really still very, very high. And so I do hope that we will not completely retreat from the rest of the world, because I think there are enormous economic but also strategic and international relation benefits from being a part of the world.
Good day, everyone, and thank you for joining today's edition of Teneo Insights. I'm Kevin Kajiwara with Teneo Political Risk Advisory in New York City. Stephen Rattner is with me today. He, of course, is known to many of you as the economic analyst on Morning Joe on MSNBC, as well as for his columns in the New York Times, one of which just dropped a few minutes ago. You will also recall the integral role he played leading the restructuring of the American auto sector following the 2008 financial crisis, as in his role as counselor to the Treasury Secretary. So influential was he that the media dubbed him the Car Czar. His career has spanned journalism from the New York Times to banking at Lazard Frères, where he was deputy chairman and CEO, and Quadrangle, the media-oriented banking firm that he founded in 2000. Today, he is the chairman and CEO of Willet Advisors, the investment arm for Michael Bloomberg's personal and philanthropic assets. So Steve appears today thanks to the efforts of our mutual friend and my colleague, Nelson Schwartz. So Steve, thanks so much for joining me today. Really appreciate having you here. And I think it would be the perfect start here would be to start with the state of the economy, the state of it now, where you see it going, and what monetary and fiscal policymakers can really do about it. So let's start with inflation, right? The March data out on Tuesday, reflecting really the first full month effect, if you will, of the war. Another 40-year high at 8.5%, 8.5% year on year. How do you read this dynamic and what the role of the Fed is at this moment, and Chairman Powell himself?
Sure, Kevin. There's a lot to unpack there, and I will be happy to do that. But first, let me just thank you and Teneo and my friend Nelson Schwartz, who is a great addition to your firm, for inviting me here today. I'm very flattered to be included among your many distinguished speakers that you've had, and hope I will live up to all the nice things you just said about me. I'll do my best. Look, the economy, I think you could probably sum up with the old phrase, it was the best of times, it was the worst of times. There are many good things going on in the economy, and it is easy to lose sight of them, that the unemployment rate is down to 3.5%, that there are more jobs out there than people actually looking for them, so everyone can work. Wages, at least in nominal terms, are rising at about 6%, which is an unusually high rate of increase, and so forth. And the economy through the GDP, as measured by GDP, is certainly expanding, albeit perhaps at a somewhat slower rate at the moment. But as you implied in your opening question, it is a fact that inflation is overshadowing all of that, and rightly so. Because the inflation has reached now a level where people should be very, very worried about it. I think there was the famous debate between transitory and permanent, and I was very much on the side of the permanent crowd, led by my friend Larry Summers. It just seemed to me this was far more than some little rat going through the python kind of event. And regrettably, I wish I had been wrong. That has turned out to be the case. And when you look at the March numbers, you can see that the inflation is quite widespread, with double-digit increases in everything from furniture to peanut butter, as well as, of course, energy, the increase in gasoline alone being half of the increase in the March CPI. Look, we let this get away from us, and there was some bad luck. I will absolutely concede that, but there was also bad policy. We overstimulated the economy. The economy was like a guy who had drunk too many cups of coffee in the morning. It was just vibrating with all this money sloshing around, and that came in two ways. It came from some of the stimulus programs that were passed by Congress, some of them, particularly in the early days of the pandemic, were appropriate and necessary. the last one, the American Jobs Plan, which was passed in the spring of 2021, $1.9 trillion, including a lot more stimulus checks and aid for states and cities and so on and so forth, was excessive. It helped create something on the order of today, $2.3 trillion of what I'll call excess savings in household bank accounts relative to what they would normally have. And so households went out and tried to spend it. And when they did, it collided with not just particularly pandemic or Ukraine-related bottlenecks, but just simply trying to suddenly again get the economy to produce more goods and services than it was used to producing, and that created bottlenecks and it created inflation. And so here we are. I should have mentioned the Fed's role. The Fed had a little bit, and we all did, of PTSD from 2008 in the sense that it's widely agreed that we reacted to the great financial crisis in terms of the policy responses then. And so there was a tendency, there was a saying in the White House in the spring of 2021 when the Biden administration arrived, it's better to do too much than too little, meaning better err on the side of too much rather than too little. And we did. Both at the stimulus level, the fiscal policy level, as well as Fed, which of course kept interest rates at zero, bought several $1 trillion of securities, including some kinds of securities that they had never bought before in any other rescue operation. And it turned out to be too much. And now we have to dial it back. And that is principally going to be the responsibility of the Fed, but we can talk about the responsibility of the Congress and the White House as well. And it's going to be very painful. It's going, in my opinion, require interest rates to go up to substantially higher levels than the market is currently anticipating. It's probably going to result in a recession. There's no precedent in history for unwinding an inflation problem of this magnitude without a recession, because you obviously have to reduce demand. And that's what I think we're looking forward to in a sense. I would say it's possible that we are close to peak inflation. I wouldn't necessarily stake my reputation on it, but you are starting to see, for example, used car prices, which were a big driver, are coming down. Gasoline, which I mentioned is half of the increase in March alone, has come down 10 cents a gallon since those numbers were collected. It's not a huge amount, but it's something. And so at least for it to flatten, even if it doesn't, as you know, the math is if like gasoline stays at the $4.10 level that it's at now nationally, but doesn't go up, doesn't go down, then that's actually zero inflation, oddly enough, even though you're at a very high level. So it's possible the numbers could look a bit better, but still to get back to 2% from 8.5% is going to take an enormous amount of effort by the Fed. So I apologize for going on so long, but I'll stop there and let you follow up.
Sure, that's perfect, and thank you for setting the stage like that. And I want to unpack something that you just started talking about here a moment ago, which is with regards to the Fed. You talked about there's an element of bad luck here. There's an element of bad policy making. There's an element of some PTSD from previous crises, and that that notion that we're always sort of fighting the last war rather than the next one. But why, in your view, did the Fed, and let's call the broader community of team transitory, if you will, get inflation wrong, do you think? I mean, obviously, we've got very smart people out there who are dealing with the same inputs of information, and yet there's this debate and uncertainty. To your point, you've got Larry Summers on the one side, who is obviously, and this has implications clearly for going forward, that rates are going to need to go higher than inflation. And you've got Jay Powell and the power of the economists at the Fed on the other, suggesting that sort of inflation will go away on its own if you've got sound fiscal policy. But yet, it seemed that there was this sort of fundamental misread that the supply shock in the pandemic was absolutely real, but the demand shock was more akin, really, at the end of the day, to like a prolonged snow day. It wasn't that nobody wanted to eat at restaurants; it was that restaurants were closed because of the pandemic. When they reopened, demand came back, but then you put on top of that, several $1 trillion worth of stimulus. So, why do you think they got it wrong?
Yeah. That is the $64,000 question. First, I would just point out in terms of the supply shock or whatever you want to call it, the demand shock, the supply shock was really created by the demand shock. If you look, for example, at the port of Los Angeles, which famously, all the container ships sitting waiting to be unloaded, the port of Los Angeles has been still processing something like 20% more volume than it's normally used to processing. So it's not like the existing amount of supply that was available became constrained. Yeah, there were some examples here and there, I'm sure. It's more that the demand just wasn't, the supply just couldn't keep up with what was very unusual demand. Why did they get it wrong? I think there was a piece of the PTSD, as I said. I think there was a piece of the Biden administration believing that both for economic and political reasons, it was better to do too much than too little. I think they just didn't imagine that this would cause a level of embedded inflation to the extent that it has. And I think the Fed, quite honestly, and I love the Fed, and I think it is one of our sort of last great institutions that still functions in a very data-driven, apolitical manner. But I think in this case, I think there were some politics here in the sense that Jay Powell was up for reappointment. The Fed certainly did not want to become the whipping boy if the recovery had not unfolded and if they had done too little. And so I just think there was a lot of institutional momentum on the side of doing more. And remember also, to be fair to everybody here, for the last really 10 years since the financial crisis, the biggest economic policy issue was how to create more inflation, not how to create less inflation. The Fed had set this target of 2%, couldn't get inflation to 2%, changed the goalpost a bit by saying that they would try to overshoot the 2% and average 2%, all to try to convince the market that and change expectations to get to 2%, because deflation can be as big of a problem as inflation. And so I think they're just different pieces of the puzzle that just all led to this mistake. And obviously it's a little bit analogous and similar to the mistake that was made in the late 60s when we felt that we could have guns and butter, and we ended up triggering and just as is happening now, to a degree, we had bad luck in the early 70s with the oil embargo, and this time we're having bad luck with Ukraine, which has exacerbated the problem. Obviously, if we hadn't created the problem in the first place, Ukraine might have created a smaller problem, but we already, again, to use a pretty prosaic analogy, we had the fire going and Ukraine just threw another log on it. If we hadn't had the fire going quite so strongly, the impact of Ukraine would have been a bit less.
Hey, as an aside, do you think that the phenomenon that we're seeing unfolding in front of us now is going to put the final nail in the coffin to the proponents of modern monetary theory?
I hope so.
MMT.
I truly hope so. It is one of the craziest ideas, since like the hula hoop to come along. So and it's interesting you say that, because we have not heard much about it in the last couple of months, and perhaps we won't for the rest of my life anyway.
Yeah,
crazy
exactly.
Theory.
So you alluded to this a little bit, but maybe since we're talking about policy going forward, there are conundrums that are or complications that are presented by the situation, and if we disaggregate on inflation here a little bit, I mean, clearly food and energy prices rising fast, but core, as defined by food and energy, decelerated slightly, right? I mean, it was 0.3%, which is the slowest rise since September. So are you seeing, any indication that some of the, and notwithstanding the latest issues out of China and the COVID-related lockdowns at export points, but that some of the supply chain dislocations are starting to work their way out in the global system, and then obviously on the other hand, wage inflation has been soaring, but with inflation, we're actually talking about a real wage decrease, right? So it seems like a major policy mess to try to unravel here, with the clock ticking towards a midterm election and obviously a presidential election not that much further down the road.
Sure. So we can come to the policy. Let's start with what's going on out there, at least what I think is going on out there. So I think you are correct that I think that with a couple of big asterisks, which I'll get to very quickly, I think the previously existing supply chain issues have started to sort themselves out. I think the rush of demand has decreased a bit. The bottlenecks have been addressed a bit. And I think that in terms of just the movement of goods through the supply chain has generally gotten a bit easier. But there are two big asterisks. One of them is China, which, as you know, is having its COVID problems and is still choosing to respond to them by enforcing the zero, or trying to enforce, it's not really working anymore, a zero COVID tolerance policy. But what they are doing is locking down huge sections of the population, particularly starting in Shanghai and Shenzhen, which is their big manufacturing area. And while I have not seen yet that have a major impact on supplies, on supply chains, I think it's entirely possible that it will. And nobody really has any idea, including, it appears, the Chinese leadership, as to where they're going in terms of having to address the COVID problem that they have. But that could well have an impact on us in terms of supplies. And the second one, of course, is Ukraine and Russia. And I know you mentioned this in your opening remarks, so I won't get too deeply, and I'll let you come back with questions or anything you want to talk about that. But the Russia-Ukraine situation is already creating a whole nother set of supply issues, more in the raw materials area, which is what comes out of those countries rather than the finished goods that typically come out of China. But that's already having a major impact on prices as well. Look, in terms of the policy response, there is unfortunately no free lunch here. There is no particularly easy way out of this. We are going to take, and I, again, don't want to start everyone's day and beginning almost of a holiday weekend with bad news, but we are going to have to take the pain of this, and we can talk about what that might consist of. But the point I would just make for the moment is that I think history has told us, well, let me say, actually, sorry, remind me one other thing. So wages are rising, and as you say, they're rising by less than inflation, but they're still rising by 6% at the moment. And those are costs that businesses are going to try to pass on. And if they succeed, it will create more inflation. So as I said in my opening remarks, I think you get into this issue of what's called base effect, where if one commodity or whatever goes up to a high level, but it doesn't go up anymore, it then becomes zero inflation contributor to the CPI. And so there will be some of that. But the point is that you still have these other cost pressures building. The CPI does not, it measures housing in a very funny way, which I'll spare everybody. But the consequence of that is there's probably more inflation from house prices to come, even though mortgage rates have gone up so much, house prices may not go up that much more, but that's still working its way through the system. Anyway, look, the point is that once inflationary expectations become embedded, and once people expect inflation, it gets harder and harder to get it out of the economy. And so my strong view is that the Fed needs to move quickly and aggressively. And as I said earlier, there's also a role for fiscal policy here to start to reduce the deficit, which we allowed obviously to get to very high levels for good reason, but now it's time to bring it back and try to take the pain. I think if we take the pain earlier, there'll be less pain than if we wait and take it later.
Yeah, it's really remarkable. I think as we sort of evolve now into talking a bit about the political response to all of this, that in some ways the most remarkable element of the inflation conundrum isn't the number itself. It is that it is the number one point of conversation amongst the concerns of the electorate. Whereas we went for basically 30, 40 years where inflation really wasn't talked about at all. So that's been a major change. Now, before we get into the politics, though, I do want to clarify. You said something, and I just want to make sure we're clear on it. And you said it in the context of Larry Summers, who you worked with obviously closely in the Obama administration and previously, and who was recently on this call. But as you pointed out, he's reminded us that we've never had the phenomenon of inflation over 4% and unemployment below 5% and not had a recession within 2 years. So are we headed toward a hard landing? And when you think about within 2 years, that obviously puts us up against a 2024 presidential election cycle. So what is your current view on whether a recession is avoidable and what the characteristics of how we get there might look like?
Yeah, look, I think, when someone makes economic predictions, you really should put them in the context of probabilities, not flat out predictions, because economics is a science only up to a point, and there's many, many things that can happen, and anyone who says X or Y is absolutely going to happen is not behaving responsibly. So I would put it in the context of saying that I think that, yeah, you can go back in history and talk about what Larry likes to use. You can talk about the yield curve being inverted, where long-term interest rates are lower than short-term interest rates has been a signal in the past. And all of them point to recession. But I think also just simply looking at the Fed, I also think it's true that the Fed has never been able to address inflation without raising nominal interest rates, the actual interest rate above the inflation rate. And right now, nominal interest rates are still below 1% in the short end, and the inflation rate's 8.5%. So the Fed has a long way to go. And I think it's going to require, and the market thinks interest rates are going to top out in the 3 or 3.5% range. I think people are kidding themselves if they think that. And so I think we're looking at far higher interest rates than the market is assuming, and that's going to have a more consequential effect on the economy. And so, yeah, I would say the odds are substantially greater than 50-50. Are they 75%? Are they 80%? I don't know, but something in that zip code, I think, are the chances that we're going to have a recession in the next. And now I don't think we're going to have it this year, because there is this $2.3 trillion in people's bank accounts that they're going to try to spend. So I think it is probably a 2024, late 23 or 24 kind of phenomenon. And, I reminded myself, I guess, the other day that back in my early part of my career, I was a New York Times reporter. And in I think it was 79, I wrote a cover story for the Times Magazine, and the headline they put on it was called "The Risky Politics of Recession." And it was basically about how the Carter administration was trying to engineer a recession to get the inflation rate down and get all that done before the election of 1980, so he would hopefully get reelected. Obviously, that didn't work out for him. Personally, I hope it will work out for Joe Biden and the country to get this under control before 2024. But I think it is very, very possible that we'll go into the 2024 election with an economy that just doesn't feel very good, that it could be simply still growing, but with a lot of inflation. We could be in stagflation, meaning that we have inflation and a little bit of growth, or we could be in an outright recession. I don't really see a scenario, but it's possible that we're going to be back to 2% inflation and 3.5% unemployment and 3% growth, and everybody's going to be happy as can be.
Okay, so let's dive into the politics here a little bit, but I do have one final Fed question, and that is, do you think that part of the problem, either in where we are now, or is it concerning as we contemplate Fed policy going forward, that there's been some mission creep on the part of the Fed beyond, beyond targeting inflation and full employment, that there has been, this sort of move toward, let's just be honest, the Fed taking on some of the responsibilities that ought to be resting with fiscal authorities and other political figures regarding the inequities in our economy and so on and so forth. And has that muddied their role a little bit?
That's a great question. It's one I've thought about in an even broader context. So if you don't mind, I'll address it in a broader context. I think what's going on, I don't think it's that the Fed has taken this on. I think the Fed is being pushed to take it on. And what I mean by that is that I think what's going on in the very broadest context in our society to some degree is that Washington and Congress being gridlocked and not really getting a heck of a lot done has not been able to solve problems, whether it's climate, whether it's diversity and inclusion, whether it's other kinds of social issues, we've not been able to solve them in Washington. And so there's an enormous amount of pressure now on other institutions to solve them. And before I get to the Fed, there's an enormous amount of pressure on companies to solve it. There's an enormous amount of pressure on the private sector to solve it, to essentially take on responsibilities that were the province of Washington, education, training, diversity, and so forth, and solve these problems. And some of them fine, but I don't think we should get in the business of trying to ask parts of our society, institutions, to solve problems they weren't put in place to solve. And that gets to the Fed. I don't believe the Fed is raising its hand saying we want to solve climate, but there's an enormous amount of pressure on the Fed to address climate, of all things. There's obviously an enormous amount of pressure on the Fed to address diversity and inclusion, not in its own ranks, but out among the banks that it supervises and things like that.
Right.
And I think that's all a big mistake. I'm in favor of addressing all those issues and all those problems. But look, we already took the Fed's original mandate, which was basically price stability. And in the late 1970s, we passed the Humphrey-Hawkins bill that said it should also address full employment and try to achieve both full employment and low inflation. And so it has a dual mandate now. And I think two mandates are enough. And we should let the Fed, it's got an unbelievably important job. And there's nothing more important to the prosperity and success of every group of Americans than having the Fed do its job well. And so let it do its job well, and let other parts of our government, our private institutions, our NGOs, and so forth address all these other very important issues.
So let's turn to our elected officials now, because my colleague and frequent guest on this program, Orson Porter, always loves to argue that there are two really important numbers in Washington right now. One is 208 and the other one is 410. 208 is the number of days until the midterm elections. $4.10 is the price of a gallon of gas, albeit down from a March peak, I think you suggested a little while ago, of $4.33. I guess the question is, the president has taken certain actions, right? He has taken an action on an unprecedented release of the SPR, a million barrels a day for the next 6 months. Controversial move on the ethanol mix, which will certainly irk some, pressuring the EU on SPR, et cetera. But what can he actually do to bring down price at the pump?
Damn little, bordering on nothing. Look, we had, and this is not widely appreciated, but we had an oil and natural gas problem before Ukraine occurred. We were already looking at substantially tightening markets. We have been under exploring and drilling for oil and gas for the last several years. And that's really been not a government decision, but a private sector phenomenon, because since the 2016 real drop in oil prices and then the pandemic, there's been enormous pressure from investors on the oil and gas companies to distribute their cash flow, get their debt down, and not spend so much money going out drilling. And so drilling had reached a very low level even before all this happened. And you were starting to see the price of oil and gas go up before Ukraine. It wouldn't have gotten probably to these levels, but it would have gone up significantly. Oil and gas has always been a cyclical business, boom bust business. Prices go up, everybody goes out and drills for a lot. All that extra supply either drives prices down, or the high prices that existed push economies into slower growth and demand goes down. But it's always been like that. And unfortunately, unfortunately for the administration, a period of tight supply was already occurring even before Ukraine occurred. And then you throw Ukraine on top of it, Russia being the third largest oil producing country in the world and a substantial exporter as well as of natural gas, mostly to Europe, as we all have learned. And you have this enormous upward pressure on prices. These are volatile markets. It does not take much of a movement in the supply-demand balance for prices to move dramatically, as we've seen. And so there is, I would think there's something close to panic in the White House about the political impact of all that. in the coming election. And so they're doing what I would do if I were there, which is rushing around trying to find everything they can think of to at least symbolically show the country they care. And I think that's important politically. I think it will help them, for the country to believe, for voters to believe that they're out there trying and are really doing everything they can do to get the price of gasoline down. But that said, I don't think you're going to see a lot of impact. We're going to release 1 million barrels a day from our Strategic Petroleum Reserve. Oil is a worldwide commodity. It travels all over the world. The world consumes about close to 100 million barrels a day. So adding 1 million barrels a day to the world supply, may make some difference on the margin. It's not going to bring gas back to $3, that's for sure. Same with ethanol, and you can go through the whole checklist of things that they've been talking about. But so the bottom line is no, I think gasoline, as I said, may not continue to go up, but on present course and speed, you got to believe gasoline is going to be above $4 on election day, and that is a number that will make voters very, very unhappy.
Yeah, and in a sense, the administration has also created a floor on the price, by suggesting that they would refill SPR at a price of $80 a barrel, which is about where we were pre-pandemic, and given the supply demand profile that you were talking about, even before the Russia-Ukraine war. But when you pull back a little bit and look at the economy more broadly, with these economic imperatives that the administration has, with the ticking clock of the election, when you add all that up, though, do you see? Are they actually making serious policy here? You talked about part of the reason we are where we are is because of excess stimulus in response to the pandemic. But other policies that are in place, from the Buy American policies, which obviously has a higher price implication, small business programs, which also has a higher price implication, student loan holidays, which is just heating up an economy that needs to be cooled even further. Gas tax holiday talks, which is stimulative of demand. We need to be restraining demand, right? So is this actually adding up to serious economic policy, or is it just sort of populist, for lack of a better term?
Yeah, no, you put your finger on it. The conundrum they face is that we should be reducing demand now, and they are still trying to pursue policies in some respects that would increase demand to achieve other objectives that they have. And it's a tough proposition for them, because I think, again, I don't think they want to or are willing to essentially go out there and articulate very clearly that we need to look. If you wanted to, I alluded to this before, but I'll bring it up now. If you wanted to really try to make some impact on inflation and take some pressure off the Fed, you would attack the budget deficit, which, again, we allowed to go up a lot for very good reasons during the pandemic. But now it's time to bring it down. And Joe Manchin has been talking about that, but he's about the only one pretty much who was talking about it. But bringing the budget deficit down, there's only two ways to do it, right? Either raise taxes or cut spending. And there's certainly no appetite to raise taxes by any appreciable amount, on individuals anyway. And there's no appetite really to cut sort of spending that Democrats view as priorities, whether it's education or health or whatever, from that discretionary part of the budget. And I think post-Ukraine, it seems very unlikely we're going to cut the defense budget, which is the other big pot of money that's floating around out there. And so, yeah, I think they are trying to a little bit have it both ways. They're trying to articulate policies, even if they don't pursue them. Like student loan debt forgiveness, they've extended the moratorium on student debt interest payments, but they haven't yet addressed the question of total forgiveness. But they're trying to lean in, as we say in the White House, on those issues without actually necessarily doing anything, either because they can't or they're not ready to, or who knows why. But yeah, that is all part of their mantra.
So you referred earlier to the inverted yield curve, which is, as we all know, has accurately predicted all past recessions, but also predicted recessions that never happened. And yet on the equity side, S&P aggregate forward earnings multiple right now is about 19 times. So continuing to anticipate strong earnings growth. How do you read the market right now in terms of, versus the picture you have just painted for us in terms of the future prospects of the economy, and where the market is right and wrong?
Yeah, look, my view is that that the market is always very sensitive to interest rates, and never more than it is at the moment. I think interest rates, even more than earnings, and we're just literally starting earnings season. You had JP Morgan report yesterday, as we mentioned. Earnings are obviously important in the long run, but interest rates, I think, are are probably the single biggest factor driving stock price at the moment. And the reason for that is simply that investors have, to oversimplify, have a choice. You can put your money into stocks, you can put your money into bonds. And for the last several years, the money's been going into stocks because bonds, short-term paper anyway, has been yielding nothing. And even long-term paper was yielding a couple percent at the depths of the pandemic. And so it made equities more attractive. You had this huge run-up in stock prices as a result of all the money flooding into equities. But once the Fed started raising interest rates, that had the opposite effect. And it particularly had an effect, as we're seeing, on what we call long-dated cash flows. In other words, companies like these startup tech companies that don't have earnings or cash flow at the moment, and it's all out there somewhere. The way an investor would model, you'd model that by discounting the future cash flows to the present, and then saying, okay, the company is worth X. Well, when interest rates go up, that rate at which you discount those cash flows also goes up, and it makes the value of the companies go down. And so what you've seen happen in the market over the last 3 or 4 months should not be that surprising to anybody, which is the whole market being fairly weak and going down, not hugely, but a bit. But inside of that overall picture, you've seen companies whose cash flows are more on the come, so to speak, go down by more, a lot of tech companies, by far more than companies that are producing cash flow here and now. And so you've had what we call a rotation back to value from growth. We'd had a big surge of growth investing over the last 5-6 years, and now it's rotating back to value. So inside of the overall market, you've had a huge rotation in which stocks have done well and which stocks haven't done well. And so we are very nervous about the market, because if you accept my basic baseline forecast that inflation is going to be worse than people think, interest rates are going to be higher than people expect, that is really bad for the market. And growth is going to be less than people expect. Those are all really bad for the market. And there's almost no place to hide in the market at the moment. There's almost no sector that you can point to that says, in a slow growth, recessionary, somewhere between slow growth and recessionary economy with high inflation, what would you invest in? The answer is basically almost nothing, other than possibly commodities and energy. But even so-called value stocks and cyclical stocks would be hurt in that environment. So we are not very constructive on the market. I'm not here to make like a huge market call, but it feels like there are more things weighing the market down than are likely to push it up.
So let's look longer term, though, because as I mentioned in my introduction of you, you run Willet, which is obviously the Bloomberg family wealth, which you're a custodian, obviously, then of very significant, but frankly generational wealth at this point, and the perpetuation of a foundation and a philanthropic organization. So it kind of forces you to have this longer term view and think about sort of thematically where things are going and the tectonic shifts in the global economy and the like. So in that context, what are the big themes that you're focusing on now going forward, notwithstanding the nearer term dislocations that you're concerned about?
Yeah, sure. So look, first of all, we remain long-term positive, constructive investors. If you believe, over the long fullness of history, stock markets have gone up roughly 75% of the time, 70% of the years, 3/4 of the years the market goes up. And I see no reason why that should change in the long term looking ahead. If you believe that the U.S., we can start with the U.S., is going to have a functioning economy, is going to produce a reasonable 2-3% level of real GDP growth over a long period, over cycles, then stocks are going to go up, because it is also true, notwithstanding what I said about interest rates being a driver at the moment, that in the long run, companies have to produce profits, and then if they do, the stocks will reflect them. And that's what I used to tell my corporate clients, and that's what I believe. And so we remain long-term investors in that. We think, as you look around the world, that the U.S., I'm going to put a little asterisk on China and come back to it in just 1 second, but we do believe that the U.S. Is the best house in what may be a bad neighborhood. That when you look around the rest of the world, very hard to get excited about Europe. It's got real structural problems. It's now got the Ukraine problems and energy problems on top of that. Not that exciting for investors. The emerging markets can be fine. You got to be, you are playing with matches and fire when you start with the emerging markets because they're so volatile. And so we do not do that much investing other than in India and China in the emerging markets. It's also hard to really feel like you know what you're doing when they're far away and you don't spend time there. The big question is China, and we have been very, very positive on China until the last year or so. We are quite nervous. I am quite nervous about what Xi is doing. I don't know anymore for sure that he's committed to a market economy, and if he's not, then that's obviously really bad for investors. If he is, then we can all get through this rough patch. They clearly, as I said earlier, do not have a visible, viable COVID strategy, which is a short-term concern. The longer-term concerns, as I said, are whether he really wants to. China 2 or 3 years ago, China was probably the most capitalistic country in the world, enough. In terms of the ability of entrepreneurs to go there, start a business, do very well, investors to do very well, and so forth. India, is a little bit like the old saying, "The dog ate my homework." India is always a promise that never seems to get fulfilled in terms of really achieving its potential. And so we have some investments in India, but we're far more cautious on India than we are on China.
So on that point, you've sort of set this stage. We talked about this all along about supply chain constraints that has due to the pandemic, now due to Russia, now due to the deteriorating U.S.-China relations. We have seen a move toward more reshoring and nearshoring of supply chains, building greater resiliency into supply chains. Add to that, the fact that in certain sensitive industries, we might have to have outright redundancy, of supply chains. China will have theirs, the West will have its, and then on top, and we're not even talking about the energy transition yet, which I'd like to get to in a minute. But in this environment where there's going to be, rising rates, less abundant capital, all of these things are incredibly expensive long-term investments that are confronting us now. How do you view that phenomenon?
Yeah, those are all a set of related and really important questions, and I was actually talking to some people about this yesterday. Let's just step back. We got to where we are, or at least where we were, let's say a year ago, in terms of global trade and interconnectedness for good reason. It was a way. It goes all the way back to Adam Smith and comparative advantage and lowering costs. And part of why we had this incredibly low inflation rate in this country was because business was able to continually squeeze down its costs and therefore not have to raise prices by outsourcing. You can call it that as an example. And so we moved huge amounts of our supply to China, to Southeast Asia, to Mexico, all because they could produce stuff cheaper and in many cases better then we could produce it here. And American consumers were the beneficiaries of that. I mentioned that furniture prices were up 15% or something like that, 19% I think last month. But historically, for the last many years, has gone up by zero because furniture production moved from North Carolina to China or someplace. And there are other implications of that are not great for those workers, but from an overall economic point of view, we benefited enormously from that. Now, the question is, how much of that is going to get unwound? And I'm not sure how much is really going to get unwound at the end, because it's not something that Washington decides. As you said, there may be some critical industries where Washington gets involved, semiconductors, encouraging like Intel to put that plant in Columbus, Ohio, and so forth. But for the most part, these are all individual decisions by thousands of companies as to how to operate. And there's no doubt that post-COVID, post-Ukraine, CEOs are sitting down saying, let me understand my source of supply. Am I getting it all from China? I should diversify it. I should do some here, some there. And they're all thinking about it. But at the end of the day, they have to compete with other companies. And how many of them are really going to voluntarily accept higher cost supplies simply because they're worried about the next outbreak of COVID or the next war in Ukraine versus going back to continually trying to squeeze down their cost of goods that they then manufacture from or resell. And so I don't know how much reshoring there's really going to happen when all is said and done. But I also do know, and it was implicit in your question, that to the extent there is reshoring, it's going to add to the inflationary pressures that we feel, because it's going to raise costs and businesses are going to try to pass them along. And in terms of what would I like to see, I think on balance, we have to accept that there are global risks. There always are risks, but the benefit of trade to the average American in terms of the cost of what he or she buys is really still very, very high. And so I do hope that we will not completely retreat from the rest of the world, because I think there are enormous economic, but also strategic and international relation benefits from being a part of the world.
One of the things that's kind of gotten lost in the war and in the pandemic and whatnot is that one of the biggest phenomenon to rise in recent years in markets has been the rise of ESG related investing and ESG benchmarking and the like. And I'm wondering how you think that is going to evolve given the sort of market environment and economic environment, corporate environment and competitive environment that you think we might be moving into. Does ESG in the way that it has been set up, survive as that phenomenon? And are we also seeing an extra letter now being added to it, D, for democracy in a way? I mean, were you surprised at all to the degree to which companies actually sort of self-sanctioned? They weren't mandated by law to leave Russia necessarily, but a lot of them just did it anyway. And does that then have implications for doing business in other non-democracies, right? Whether it be Russia, Saudi Arabia, increasingly places like Turkey and others.
Yeah, those are all good questions. Look, again, I want to be careful. I want to go back to what I said before. I think we need to be careful about how much we ask companies to solve problems that are really the responsibility of government to mostly solve. And I think we want to be really careful about putting mandates on companies to solve those problems. That said, I believe in free markets and a capitalist free market system. And if either the shareholders of companies or the customers of companies want those companies to behave in a certain way, they have the right to try to influence the companies to do that. Shareholders have the right to vote for resolutions or directors or whatever that support the kinds of goals they want, if they include ESG kinds of things. And customers have a right to say, I'm not going to buy from a company that sources its products, from the Uyghurs in China or from kids working in cobalt mines in the Democratic Republic of the Congo. And so customers absolutely have the right to do that. And so what you see happening, and I do welcome this, is a lot of public pressure on these companies to behave in a certain way. And I think that that's part of a free market system, that people have that right. I don't think it should be the heavy hand of government, but I think it should be their shareholders, their customers, their employees have a right to say that too. And so I think it's fine that companies have voluntarily chosen not to do business in Ukraine. I see no sign that the government went to them and said, well, if you don't pull out of Ukraine, we're gonna make sure you don't get the next permit you want from us, or this or that. There's no heavy hand of government here. This is the market and society moving, and I think that's all fine, and I think you will continue to see that happen. And as I said, I welcome it as long as it's not the heavy hand of government.
So, you talk about this, your aversion to mandating corporate America to take certain actions, but it seems to me that the biggest issue that's kind of looming out there, and maybe the biggest opportunity / biggest risk out there, is one that requires public and private partnership, and that is going to be the energy transition. You've alluded to the lack of investment and whatnot in oil and gas drilling in recent years. Part of that, no doubt, is also due to the fact that we don't know over the lifespan of most of these types of investments where we are going to be in terms of our energy mix, especially with the intention that we get more and more to renewables and so on. There's going to be this geopolitical shift away from the oil and gas centers and more to these metals and minerals and their processing centers, meaning that China right now, I mean, you're the car czar, right? I mean, you cannot build an EV today without China's involvement. We have not isolated that that supply chain. How are you viewing energy transition writ large as an opportunity? And are we moving in the right direction, or are things just moving at so many, because there is no umbrella, I hate to use the term industrial policy on this, that we're not really going to get where we need to get?
Yeah, again, all good questions. So look, one of the interesting and in a way positive, if you want to look for small, good signs amidst a lot of bad signs out of the Ukraine situation, one of the good things is that I think it's made people, I hope, if they've paid attention, realize what can happen when you do energy transition badly, which is how Europe has been doing energy transition. Germany had 17 nuclear plants. They've shut down 14 of them. They've got 3 more to go that they're going to shut down. This was all post-Fukushima. And instead they're burning coal, which is completely insane. The Europeans were very reluctant to license LNG facilities, and so it's very hard for them to get gas from elsewhere besides China. Netherlands shut down their biggest gas field because of seismic issues that some people think anyway could have been addressed. The UK gets a huge amount of its power from wind and renewables, which is great, except when the wind doesn't blow, they have a problem because they don't have enough baseload power. And so these are all little laboratories or little case studies of what happens when you don't do policy well. And so we have to be really careful about the energy transition. I am absolutely 110% a believer that we need to make an energy transition. Most of the, if not all, of the CEOs that I know in the oil and gas business believe we have to make an energy transition. It's simply a question of how do you do it. And so from our standpoint, there's much that we could do from a policy level that would be far more constructive toward an energy transition than anything we're doing now. First and foremost, of course, would be putting a tax on carbon. You alluded to this earlier, and I forgot to pick up on it. But the idea of suspending gas taxes to deal with the high gas prices is insane. We need high gas prices to force an energy transition. We need the revenue from gas taxes to maintain our transportation infrastructure in the meantime. And why would you take these taxes off at this particular moment? I understand the pressure on consumers, but I think there would have been other better ways to address that by simply giving people a broader tax rebate or something if you really felt you needed to do something for either political or economic reasons, but to suspend gas taxes is like the worst idea of all of them. And we also have to recognize that we are going to need fossil fuels as a transition. And so therefore, trying to stop drilling or trying to put the fossil fuel companies out of business or at least put them in a box is a mistake. The other mistake we're making is not being willing to accept nuclear as part of the solution. We are still not doing anything to try to improve the licensing of nuclear plants, and the licensing requirements are so difficult that it drives the cost to a point where they're just not economic, and we haven't built one in a very, very long time, and we should be doing that. So if I could wave a magic wand and be able to impose policy, I think there's 100 ways we could do the energy transition better than the way we're doing it at the moment.
And I'm conscious of time, so I want to ask you one last question, and that is with regards to, well, Russia is the latest, but obviously this has been the case with Iran. It's been the case with North Korea, and I'm wondering about your view on the use of, economic tools as our weapon of choice to coerce changes of behavior, and what you think the impact is going to be on the dollar's status going forward. I'm in the camp that believes that the dollar is actually dollar status is a lot stickier than some people fear, but I know it's a subject of debate. So just where do you come down on what the use of sanctions and the weaponization of the dollar long-term implications are?
Sure. Okay, I'm in favor of the use of sanctions. I think we have tools in our toolbox to try to keep order in the world and punish bad actors, and certainly using economic sanctions is a lot better than sending 100,000 Marines into some country to try to get them to see the light and move in whatever direction we feel is appropriate. And you mentioned this earlier, and I also meant to pick up on this. I think what you have to recognize, particularly in the case of Russia and Ukraine, is that our ability to use sanctions is limited by the fact that we actually need all the stuff those countries export. We need the oil, and I say we, I mean the world. We need the oil and gas. We need the wheat. We need the corn. We need the palladium. We need the platinum. We need all the stuff they do. In some cases, like palladium, they produce 40% of the world's supply. In other cases, like oil and gas, it might be 10%. But even 10% of the supply of an important commodity can have massive impact on the price that consumers are having to pay all around the rest of the world. And so if you look at what we did to Russia, we've imposed all these financial sanctions. We've actually literally not sanctioned any of their exports. I don't believe in one of their exports have we directly sanctioned, except I guess we're not buying their oil, but we didn't buy any oil from them practically anyway. The U.S. didn't. And the Europeans are going to maybe get there, but they haven't gotten there yet because they need the oil and gas. And so that's the difficulty with sanctions in this particular case. In the case of Iran, it's a lot easier. There wasn't much besides oil they exported that mattered. But in the case of Russia and Ukraine, our ability is somewhat limited. So anyway, I'm in favor of using them. In terms of the dollar, I completely agree with you. I don't think you're going to find people can talk about moving away from the dollar, but where are they going to move to? Russia had diversified its foreign exchange holdings very substantially, but when we shut them out of the world payment system, we still, in effect, froze that $630 billion of foreign currencies that they hold that they couldn't use anyway. So I think we are still very much in charge of the world's financial system. I think the dollar still is the unit of exchange around the world, and I see no particular, every time something like this happens, everybody says, oh, the dollar is not going to be the reserve currency of the world anymore, but yet it is, and I see no reason why that's going to change.
Well, Steve, you've painted a very challenging, very complex and very sobering picture. I think I need a 3-day weekend to decompress from all of that. So we are up against the clock. I want to thank you very, very much for your views today. You've covered a wide range, and I appreciate your being sporting and being game for all of that. A lot of it we could go into much deeper. So hopefully one day you'll come back. But meanwhile, I want to thank you for joining us. I want to thank everybody for joining us today. Hopefully you all get a 3-day weekend. It's a beautiful day here in New York, so enjoy it. Until next time, we'll be back in 2 weeks with the next edition of Teneo Insights. Until then, I'm Kevin Kajiwara in New York. Thanks again.